Since early 2021, the cost of housing has undergone a massive shift. Mortgage rates showed up from 2.65% to the 7% range, while the median rent in the United States crossed over $1,942 a month. The classic rules of personal finance were drafted during a period of much lower asset prices and higher relative wages. Today, these formulas face a market they were not designed to handle. To see where you fit in this economy, we have to run the math. We're going to audit 3 major housing rules against 3 specific income brackets: $40,000, $80,000, and $150,000 a year. This analysis highlights a specific choice many people face: adhere to traditional safety rules and risk being priced out entirely, or break those rules to actually participate in the market. If you realize you fall short of these traditional targets, keep in mind that this is the mathematical reality of housing prices colliding with average wages. Generic financial advice often fails to account for current market conditions. Establishing true affordability requires a strategy tailored to your income bracket and geographic location. The 30% rule is the standard baseline for renting. It suggests capping your monthly housing costs at 30% of your gross income. A $40,000 salary limits you to $1,000 a month. $80,000 affords $2,000. $150,000 allows $3,700. Compare that to the national median rent of $1,942. Average U.S. earners fall almost $1,000 short. This rule exists to preserve cash flow. It ensures you have enough remaining income for non-negotiable living expenses, student loans, and high-interest credit card debt. For median earners, following this rule today requires significant lifestyle changes, often taking on multiple roommates or relocating away from major cities to find a lower cost of entry. In the current economy, the 30% rent rule serves more as an indicator of geographic exclusion for average earners than a practical budgeting guideline. When transitioning to homeownership, the bank introduces the 28-36 rule. This is the primary metric lenders use to evaluate your mortgage application. To qualify for a loan, your monthly mortgage payment must stay under 28% of your gross income. Additionally, your total debt obligations, including car loans and student debt, must remain below a 36% ceiling. This formula exists to protect the lender. It calculates the statistical probability that you will make your payments without defaulting. It ignores your personal savings goals, your future retirement contributions, and your daily lifestyle costs. The bank's only priority is receiving their monthly payment. There is a massive difference between being approved for a mortgage and being able to comfortably afford one. Treating the bank's maximum approval limit as a personal budget target is one of the most common ways to become house poor. The 33-3 rule offers a much stricter standard for financial safety. Many financial planners consider this the gold standard for buying a home. The first 30 refers to cash. It mandates that you save 30% of the home's purchase price before you even consider making an offer. This 30% splits in two: 20% for a down payment and a 10% cash buffer for repairs. But saving this takes years. While waiting, inflation drags your capital down as housing prices move out of reach. Chasing a perfect 30% cash buffer can force buyers to miss out on years of property appreciation and market gains. The final 3 of the rule suggest you should never buy a house that costs more than 3 times your annual gross salary. In high-cost areas, this math creates a massive gap. In San Francisco, an average $1.28 million home requires a salary of $429,000 to satisfy the 3x rule. Adhering strictly to this ratio forces average earners to move to Tier 2 or Tier 3 cities, where the housing-to-income ratio is more balanced. However, high earners making $150,000 or more can often afford to stretch their housing costs up to 40% of their gross income. This is because fixed costs for food and utilities do not scale linearly with income. A high earner spends a smaller relative portion of their paycheck on basic needs, leaving a larger percentage of discretionary cash available for a mortgage. Geographic realities have restricted the 3x rule to low-cost regions, effectively turning what was once a universal safety standard into a luxury. To navigate this market, we need a functional strategy. We can map out specific actions based on how your income interacts with your location. For those in the $40,000 tier, prioritizing rent stabilization and avoiding consumer debt is more important than forced homeownership. Focus on building a cash reserve while keeping your living costs as fixed as possible. In the $80,000 bracket, the 28-36 rule is your baseline. Entering the market with a 5 or 10% down payment and accepting the cost of mortgage insurance is off. If you earn over $150,000, you can consider stretching your housing budget to 40%. This requires meticulous tracking of discretionary spending to ensure your mortgage doesn't crowd out your other financial goals. Avoid the trap of comparing your progress to others. Hidden factors like family assistance or an inheritance can completely distort the financial math for individual households. Today, calculating affordability means balancing financial risk against lifestyle choices. Decades-old formulas provide a starting point, but the final decision rests on these individual trade-offs.